time here. Now moving on, BharatPe's former COO, Dhruv Dhanraj Bahl, has launched a venture capital fund which is called Eternal Capital with a target corpus of 240 crore rupees, including a greenshoe option of 120 crores. Sector agnostic in nature, the fund aims to build a diversified portfolio of solutions for the future and wants to invest in 40 startups in their seed to pre-series A stages in the next 3 years. So joining me now to discuss the fund's investment strategy and more is Dhruv Bahl, the founder and managing partner of the firm, and also with me is my colleague Shruti Mishra. Dhruv, welcome to the show and thank you very much for making it in time for us. Start by telling us about this fund that you've just launched. What's going to be your investment strategy? And while you say you're sector agnostic, are there specific areas you're excited about?
Great. Firstly, thank you for having me. It's not very often that a new fund manager gets this platform. So thank you for having me and allowing me to talk about what we're building at Eternal. Eternal fundamentally is a two-pronged thesis, right? What we're thinking and seeing across the world is that more and more operators are creating great companies. They add value, they multiply the money that venture capitalists put in them. But when the time comes to invest, they also become great angels and they give back, right? What you really see is operators are great at picking founders, connecting with them, picking great companies, and picking great solutions to the problems that are faced with them. So when they do become VCs, full-time VCs, like you see great firms like A16Z in the Valley, they actually beat their peers and they give greater returns. Now, that's a model that hasn't really picked up in India, and that's something that at Eternal we're very keen about bringing in, and especially with the idea that not just me as an ex-operator being the managing partner in the fund, but also with LPs being exclusively operators from the industry, who will also bring in their social and intellectual capital to not only invest in companies, but also help them grow. On the other side, what you really see, the other principle of the fund is that what you really see is people who want to invest in this asset class, which they know gives great returns, are either stuck between a situation which is, okay, I don't understand it, I don't have the network, I don't have the time, I don't understand the platforms, there is no curation, who manages my exits, a very confusing sort of entry into the asset class, or I go over to very established VC funds. The entry check is very high, and I don't end up getting, I have to pay a very high fee to get my money deployed. So how do you find balance in that? Where is the sort of wealth management angle of that for the investors?
Okay.
And that's all that we're tackling.
All right, Dhruv, this is Shruti quickly stepping in. Thank you for taking us through the model. But if you could tell us how soon you plan to start investing, what is the pipeline like? And are you already made some investments? Have you identified some companies?
Yes. So, we won't take away the thunder. We won't steal their thunder. We'll let them announce it when it happens. But we've identified about 6 companies where we are investing. We have a primarily co-invest model. So we've got great partners with whom we're entering these organizations at sort of a pre-series A stage. We are a 120 crore fund. We've received commitments for about 90% of the fund. We plan to start deploying funds in the first week of June. We are going through the regulatory paperwork that is required for us to enable these investments to go through.
Okay, so starting deployment from June and 6 firms already identified. But Dhruv, very briefly, tell us about this more skin in the game approach that you're taking with this company and the kind of cost structure you're bringing in to reimagine the VC economics for investors. What are your plans on that? Just explain how it differs from what we've already seen in the market.
So the standard VC model is 220, right? 2% over the lifetime of a fund. Average fund is 8 to 10 years. Now, if the idea is that you want to generate returns, the IRR versus CAGR game, right? IRR is a great balance sheet metric, but CAGR is money in the bank, right? So if you want to play that game of saying, look, I want to create value or wealth for my investors, for my LPs, by basically investing in great assets, growing them, and then at some point in time saying, okay, my time in sort of carrying this asset is done and handing it over to the, whatever it might be an IPO, might be an acquisition, might be a private equity investment. With that view, the idea was that should happen in as fast as you can create for them, right? So what we've done is we've capped our fee structure at 5 years versus the traditional 8 to 10 years. We've said, look, we've got skin in the game now. In 5 years, either we are able to get you exits, or if not, then we carry it out on our cost till we can get you that exit. The other thing is, I think the standard model of a 20% carry is something that we are reimagining. We've said, look, we're going to take anywhere between 50 to 75% of that if we just give you market standard returns, right? If we beat the index at that point in time. Only if we deliver above index is when we're going to actually go to that 20% number. So we said, look, we're going to only when we give superlative returns are we going to charge the market norm. And I think that's what it should be. There should be skin in the game. There should be sort of a performance-led metric.
Sure.
For VCs as well.
Okay, Dhruv, you're talking of returns and picking up from what you just said. If you could talk to us about the targets in terms of returns from these investments over a period of time, what kind of numbers are you working with? And most importantly, what sort of evaluation criteria are you putting in place to ensure that the investments are protected?
Fantastic. So let's talk about the criteria first, and then we'll talk about returns, right?
Yeah.
Because always decision leading to outcome, not outcome leading to decision, right? So the way we look at it in three ways. One, instead of boiling the ocean, what we've done is we've written a very clear thesis of what we think the next 5 to 7 years of early stage growth in India is going to come from. It's going to come from 4 or 5 core sectors, and within those 4 or 5 core sectors, there's going to be very specific thesis within the sector. So within fintech, we think a lot of it is going to come from SaaS plays within fintech. It's going to come from MSME lending. It's going to come from lending against assets. Not so much consumer lending, which has become very democratized. Hardly any margins to be made there. And so on and so forth. So every sector, we've got a very clear thesis. Second, what we do is we want to bring, we're not overawed by our own intelligence. We would like to bring at least one institutional partner with us. So we've partnered with a bunch of firms who work closely with us. We show them our pipeline. They show them, they share theirs with us. And we collaborate on coming up with a founder-first solution, right? Where does the capital, financial, social, and intellectual maximize its gain for the founder? And that's where we come in. And the third really is we try and look at it with a, I like to call it the private equity approach at a very early stage. We look at them from a dhanda perspective, right? We say, look, this really has to be a solid business and we're going to back it. So we ask 4 key questions: who, what, why, and how. Who's building it? What is the need they're addressing in the market? What kind of economics they're going to generate, and what kind of traction they are. So one thing that we don't do at Eternal is we don't really do, concept pre-seed kind of something on paper, but we do mentor people and get them to a point where they can have an institution around. So we actively work with operators, help them get their angel rounds done, get them to the point where we might be the first check-in.
Okay. All right, Dhruv, we've run out of time, but thank you very much for taking us through your investment strategy. I'm sure being an angel investor yourself, that will also play into how you make these decisions. Thank you very much for your time here on CNBC TV18.
And thank you for having me there. Thank you so much.
And from one